Hey, welcome back. You know, investing doesn't have to be the complicated thing that some people may want you to believe it is. In this video, I hope to give you some hints and maybe guide you towards what to me is real investing, the type that can make you and your future generations wealthy. Now, if you want to invest in individual stocks, and I'll go into the other option later, you must know what you invest in. For that, you need to read reports, see company presentations, as well as various news about them and the industry. Normally, what you want is either the 10Q or 10K report, meaning quarterly or annual, but often even better is the earnings release itself. A note here, you may not find presentations and stuff for every company, but the 10Q or 10K are mandatory, but at first you probably won't have to worry about these. Here you can find the quarterly or yearly highlights, as well as the income statement and the balance sheet, which are very important. If you can, let's say, master these two, you can spot issues, see the company's financial health, or rate the dividend sustainability, for example. You can predict the growth rates and stuff like that, but what you can control is picking a healthy company or at least assessing a risk and reward potential. For example, if a company has enough current assets like cash to pay all its liabilities many times, then the likelihood of going bankrupt even with a negative income for a while is very small. That can give them enough time to develop in case they are a high growth company, for example. But if they don't have cash and rely on inventories or the cash inflows, that can limit their flexibility and you might see them use a credit line, for example, which can generate interest. Then, in the cash flow statement, you can get what I think is an even better indicator than the net income, the free cash flow. This is basically the money that the company made after it paid for capital expenditures, or capex. The classic way to calculate it is to get the operating cash flow, which is basically an adjusted net income, and subtract the capex. This is then used to pay interest, debt, dividends, buybacks, stock-based compensation, and so on. It may sound complicated, but it really isn't. There is levered and unlevered free cash flow. Levered is after they pay the interest and debt in the period, unlevered is before, and it's what you normally call the free cash flow and the one that I use. If you then discount what you see on the screen from the unlevered, for example, you get the money that the company usually has left for dividends, buybacks, investing, and so on. This gives a much better idea than the net income because there are many accounting things like depreciation and amortization that go into it which aren't real costs. In the case of Warner Bros., you can see a negative net income due to huge amortization on the movies, but a very solid cash flow. These are just accounting adjustments and the role is to get some tax benefits, but the company doesn't actually pay that money. Same with fair value adjustments, for example. Imagine if the company had some stocks in another company and that crashed 50% to, let's say, $500 million. Do they actually pay $500 million? No, but it's an accounting change that they have to do in the balance sheet and it has to be justified somehow. As a recap, the income statement is good for seeing a very clear subtraction from the revenue minus interest expenses, depreciation, amortization, and so on until you get to the net income and EPS. Then, taking it a step forward and adjusting the net income, you get the free cash flow, which I think is often the best indicator because it allows you to see a very clear picture of what the company can do. And then, using things from the income statement like the interest expenses, you can get an even better idea about the truly free cash that they can make. And the balance sheet is probably the most important one because if this one isn't okay, the cash flow would have to be very good to make up for it. As a note, especially if a company has a lot of debt, you should look into the latest 10Q or 10K report and see exactly when it's due. Because a company can have a ton of debt, but if it's spread over 40 years and has a very small interest rate, it's very different than if they had to pay it over half a decade. Ultimately, you have to see those three together rather than individually, and if you do, you can even make a valuation. So I'd say understanding the financials is by far one of the most important things. If you are serious about this and want to take your researching process and keeping up with your investments to the next level, I'm a Seeking Alpha affiliate and can offer you a $25 discount on the yearly plan. Check out the link in the description for more. And now, it's very good that you are watching this kind of video and want to learn, but you have to be very careful who you listen to. I'm a very small channel and I can tell you that some of the offers that I get, and deny, don't worry, go even close to $1,000 for each person that I get into some risky stuff. Think about especially crypto and then think why that is the case. Normally, you who takes the ultimate risk end up losing with this kind of assets while the broker or the influencer that recommended that stuff to you makes a ton of money. The flashier and closer to gambling it is, the more money people can make off of you. So be very careful what and why you invest in. Also very much related, keep in mind that some companies have a much bigger following than others, which can lead to a lot of people making a ton of content about them. You know, I like and I invested in things like Nokia or Medical Properties Trust or Intel, but I'm trying to keep the coverage low even if that has a negative effect on the views, because I don't want to be one of those channels that covers every single meaningless piece of news about these companies and tries to hype them to generate a following. At the very least, this type of content can waste your time without adding any value. I think it's very important to look at stocks as the pieces of the company that they are and have a business owner's mentality. Remember that you buy the stock to get a piece of the company. The key thing to remember is that the company and the stock aren't the same. The stock can crash 20-30% in a single day, and there are countless examples even this year, but for the company itself to change that much, something exceptionally bad like a huge accident or a massive lawsuit would have to happen. A better way to look at it is the stock representing the market's expectations for the company. This is why, if you look into it, this type of crash is usually due to a cut in outlook. This usually means less growth, which then has an effect on the long term, meaning that the market has to adjust its financial models. Now, in reality, this is impossible to predict, and sometimes the market's expectations will be way too good or way too bad. This is how a majority of companies that went public during the pandemic see 70-80% lower stock prices today. As a note, you can see value investing as basically finding those companies whose stock has unjustifiably bad expectations, because sometimes a lot of things can happen that may push an entire industry into an undervalued territory. Then, when they keep proving results or something happens that makes the market realize that there is potential or this is too cheap for what they can do or the risk and reward is way too good to ignore, they have a rebound in time. Anyway, the valuation is very important no matter what you invest for. High interest rates, for example, have an effect on the risk-free treasury notes, which pushed very good quality dividend stocks into prices where they pay 5, 6, 8% dividends, and I can tell you that I bought quite a lot of that over the past couple of years. Sure, I'll probably buy some of them even at 4 or 5% yields in the future, but when you get to really understand the company, you can spot those once-in-a-decade opportunities and act accordingly. You know, I got my portfolio, and this is not a dividend portfolio by the way, to something like a 4.3% yield or 4.6% without the cash. And with this, I also want to point out that waiting for a crash is often not worth it. You know, especially if you buy the S&P 500 and some ETFs, investing regularly no matter what is statistically proven to be the most efficient way to do it. If a crash eventually comes, and it doesn't have to be a general market crash as we can see with many dividend stocks, I see it as a potential opportunity to buy at a better price. Probably one of the most important things about investing you can easily do is making it a habit. You know, managing your money, saving and investing already puts you in a better position than I think it was around 80% of people. You don't even need to be some top manager or something like that. Even someone on an average income can amass a lot of money if they focus on making this a habit. Someone with a decent salary plus maybe 1 or 2 small sources of income can even think about retiring and living off dividends in their mid-40s or 50s, depending on when they start this habit and how much they can make and save. If you begin in your 20s and invest an average of around $1,000 per month, by the time you are 50, it's very likely that you'll be a millionaire. Sure, it's worth less after inflation, but that would still be a very significant amount of money. In some countries, by the time you have a $500,000 portfolio paying you, let's say 4% per year, meaning $1,600 a month, you already don't have to worry about a job, especially if you develop some other sources of income during that time. At the very least, you should have much more freedom and should be able to do what you enjoy much more than if you depend on a job. And I'm not saying do nothing and save everything. Enjoy your life, but keep in mind that it's still your life even at 40, 50, 60, 100 and so on. You don't want to be 70 and still have to work because the pension isn't enough, especially with the way the pension system works in a majority of countries and an aging population. And this gets me to another point, anchoring. This is basically when you use a previous price to make decisions like it was 10 before, so I'm not buying until it falls to 10 again, or this was 100 before, so I'm buying because it's 70 now. That can lead to missing opportunities or overpaying because at every point the price is the result of many unpredictable factors. Maybe back then there was a pandemic or some lawsuits or any kind of negative news. Plus, that doesn't account for the company's development. If you look at PayPal, for example, 3 years ago this was 5 times more expensive than today. Sure, there is potential to recover, but it's very unlikely to see 300 again because the company simply isn't worth that much. So the price is something you should look at in relation to the company instead of a potential indicator of a bottom or potential recovery or anything like that. As a note, this isn't the same as being patient. That's when you wait based on the margin of safety that you want and the result of your valuation. Now, there is the question of what to invest in. I legally can't tell you what to buy and I don't know your financial situation and why you invest, but I think you have to balance the time you put in with the potential result. I'm close to making a living out of investing, so for me it makes sense to put, 5-6 hours of work per day into this kind of thing. Even this part is recorded at 9:50 p.m, so as with anything, you need to put in the time if you want to maybe see the results. But I know that for a majority of people that's not the case. After working 8 hours per day and spending 1, 2, 3 hours commuting to and from the job, you simply don't have that kind of time. But over the past decade, the S&P 500 had a compound annual growth rate of around 12% and the overall growth rate is around 10% per year. It doesn't mean it will keep doing that, but for a majority of people, even half of that should be enough to help you reach your goals. With all this work, I got something like a 15-20% compound growth rate, which sure is a huge difference, but this is nights and weekends and holidays that I had to sacrifice. If you're watching this, you probably want to go beyond just the S&P, which is very good, but if I started now, I think I would go like 80% into the S&P or other ETFs and slowly diversify with individual companies over years as I research and learn more and more. Imagine if you listened or followed Katie Wood during the pandemic hype. She was extremely pushed by the media back then, so it's very likely that a new person would simply copy what she does. You would have bought every IPO without having any data about them and what they can do, and now you would have been down like 80% overall. For a majority of people, that is enough to make them quit, which is one of the worst things possible. Again, investing is more about the time in the market and making it a habit than trying to beat it. Imagine if you just invested in the S&P in the 80s or 90s. No stock picking, just no matter what happened, saving and putting let's say 10-20% of your income per month into the S&P and other ETFs. You'd have probably had more than enough to retire now. Sure, it was much more difficult and more expensive back then, but now with 50 big brokers in any country and close to zero commission and so much free information available, if you are in the financial position to do it, you don't have an excuse. And even if for some reason you get half of the rate the S&P has returned so far, that's still very good. And the thing is, with more and more people and their money going into the market, even with ups and downs or last decades, the average return might continue to be very good. Now, I know there will be many people telling you how much money you can make by trading or playing with options or crypto. Again, these are indeed the most profitable, but for the person that gets you into them. I've heard this idea before and people may not realize it, but if you make 1% per day with let's say 250 working days per year, you don't make 250%. With compounding, that's over 1200%. If you do that for 3 years, you turn $1,000 into something like 1.75 million. Do you think that's realistic and some 20-year-old knows how to do that? And if they can make that much money, why do they have to sell that information to you as a paid course? Look, it's easy to make some money when the market is up. But what if there is another last decade like the one we saw in the early 2000s? This kind of get-rich-quick mentality would probably lead to you either going into even riskier things or end up quitting, which is, again, one of the worst things you can do. The way I see that last decade is as probably the best opportunity we had in recent history to build a great portfolio at a good price. But you know how they say, the second best time is today. The market will likely keep going up in the long term, but that, thankfully, doesn't mean every year will be green. Keep in mind that the more the market is up, the more you have to pay. Even Warren Buffett had some very negative years in his career, but he still managed to make a lot of money and became probably the most well-known investor on the planet. Talking about courses, someone even contacted me about making such a course, telling me how much money I could make, and I refused. If I can negotiate some discount or a sign-up bonus for you, like the ones you can find in the description, and make some money on the side, fine. But selling this and making money basically out of your pocket is something I don't want to do. I have my portfolio, dividends, salary, ads income, affiliates and more, which will eventually be enough to allow me not to gatekeep information behind a paywall. You know, I'm supposed to be a person that made money from what I'm teaching, but before I teach it, not make money out of the act of teaching it, right? I know it's pretty much a standard at this point, but I want to keep everything that I have to offer available for free. Instead of paying me $2, $3, $500 for a course, I'd much rather see you invest it. So, at the end of the day, investing doesn't have to be complicated, and I think it should be part of everyone's life. I think demystifying this and having given a basic understanding of the financial concepts can have a very good impact on your quality of life. The effect of compounding, even at a small rate above inflation, is simply too good, and for many people it can at least offer a lot of financial stability, which is very much needed. Again, you don't have to be a millionaire or a financial expert to make good money out of long-term investing. You can do it even on a budget, and the earlier you make it a habit, the better. If you have any questions, I'd be happy to answer them, so please leave a comment. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.